Well, in recent months, there's been a great deal of news about the Ivy League colleges, and we're going to visit that subject, but from a different angle. We know from the political side that the Ivy League colleges have been harassed a great deal about breaking the rules from a constitutional standpoint in favor of their own set of rules. Not that it wasn't helped along with politics in the prior administration, but the rules we're talking about are the investing rules. I remember a couple of decades ago meeting with a physician who was retired and his wife, and we're going over their portfolio, and he said, "Boy, I sure wish our returns were like that of the Harvard Trust Fund. The endowment there is, they just do a phenomenal job." And I said, "Yes, they do, but they invest in a lot of things that we just can't go invest in. For instance, they buy timber farms that cover mountains worth of territory, and it
They do.
doesn't quite fit in your IRA. There's not enough money to do that." And the problem that creates is who's going to determine the value of, in this case, the timber or maybe some other asset that isn't publicly traded. You may not think that's a problem, but that's a serious problem, particularly for the endowments as they are now finding out, and for you as an individual investor, particularly if you're participating in a 401k plan. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
And so what's the problem that you may potentially face in your 401k plan is that the endowments, which are massive endowments, they're billions of dollars at Harvard and Yale and Georgetown and the like. And you say, well, they've got tons of money. And first of all, we ask the question, with all that money, why are they going to the government to finance their student expenses? You know, they could
Another good question.
They could make the loans to their students, expecting the alumni to be loyal, pay back the loans, good investments. But they don't want to make that investment, so they go out and they buy other alternative assets. Why alternative? Well, because you get in on the ground floor. It's the promise of opportunity that's unavailable to the schmucks like you and me. We can't write a check for $10 billion to buy up the initial private offering before it goes public. We just don't have the money to do that.
Correct. So, and that's what they're looking for. That's where their biggest returns come from. Those private equity positions that they take, and which by definition means they are not publicly traded, and the valuations that they get from those are from the investment sponsors who say, here's how much it's worth now, and you just get to record that as a real number, and it all works until you want to sell it. And when you need to sell it, you may or may not find a taker.
We've seen this play before. If we go back to the 70s, one of the hot mutual funds in the early 70s was run by Jerry Tsai. And that was a period where, to raise money, companies sold letter stock. This is stock that wasn't trading in the open market. And the question was, how do you value it? Well, they would say, well, there's a lot of extra value here because of the private nature of this, and we just simply haven't monetized all the benefits of the company, its products. But we'll take the publicly traded price as a base and add a factor for the real potential that's here. And that worked. But basically, it was Jerry Tsai and his committee got to determine what his investments were worth, and then they reported that on a share basis to the newspapers who published the price. And it created a massively attractive mountain chart for their mutual fund return. That's basically what's gone on with private equity in these big endowment funds that have had a ton of money to invest. And it's kind of like, well, blue chip stocks and dividends are so old-fashioned, so old hum. And after all, we are the elite of finance. We should be able to do better. And so they did better by buying things that have no market And that's really a system there that this whole process that most people don't understand. The investment committee generally is a bunch of academics who don't have a lot of real world experience at much of anything other than holding class. So what they do for the pension plan to be sure they are adequately diversified is they hire one or more consultants who bring them opportunities that nobody else gets to look at. And you are special. You have this money. You can invest in this before it goes public. And so they spent money. And the net result is that, as we have found over this last year, when the government stopped funding their educational system and their grants, they needed money. Well, you would think they could go to their multi-billion-dollar pension plans or endowments and withdraw some. On a pension plan, they borrow it. With an endowment, they could pay it out or lend it, either way. But there's not enough cash. And in fact, there's not enough liquidity. Their stock exposure and their bond exposure and even their international stock exposure, which is larger than the other two combined at 17%, they don't have enough liquidity. Liquidity is what drives markets, and liquidity is what saves you when markets tank. Liquidity is what gives you the opportunity to benefit from the investments that are working when you need the money downstream. And the Harvard and the Yale and the like, they ignored the liquidity rule. They just simply kept investing in alternative assets. Now, what's all this mean for you? The risk for you is that now that these endowment plans are no longer going to buy alternatives because they're out of money and they need money, they want to sell their alternative investments. And the consulting industry needs a place to dump them. You're in line. You own a 401k plan. They're already knocking on the door of the SEC and Congress saying, these are real money-making opportunities. They've worked really well for these endowments at Harvard and Yale and the like. They should be made available to Joe Blow and Jane Doe. They should have the same opportunity that the Ivy League had. What, you mean the same opportunity to find out you need money and it can't be sold? That's the opportunity. When the surveys say that the average person in a 401k plan lacks substantial financial management background for trading even basic mutual funds and figuring out whether they should own an index or not. So we're going to give them an opportunity to invest in complicated, non-liquid assets and assume that they know how to properly place that in a portfolio to manage their own risk and liquidity needs. This makes absolutely no sense whatsoever from a fiduciary standpoint. The same thing applies to what's going on in the crypto proposals to put crypto in 401k, because it's been in the news and there is pressure from speculators, some of whom have made money owning crypto in various forms. But again, you go to the 401k plan, which is supposed to be serious money for their retirement, and we're going to give them an opportunity to participate in highly volatile assets of a digital nature, of nothing that they can redeem at a later date to actually get their money back. You should be standing up with, if this is a proposal in your 401k plan, instead of saying, count me in, you should be going to the sponsor and saying, hey, this doesn't make any sense. And as for me, I'm not a participant here because I don't understand these things and you need to explain them to me. And that's the problem for the trustees, because if they allow a private equity asset into the plan or crypto into the plan, and you as an employee participate in the plan and you buy those, the trustee is responsible for you having adequate knowledge about the risk associated with that, which includes the non-liquidity in private equity. Most of the trustees can't explain these themselves, much less educate participants adequately, probably even not enough to know to get personal waivers of liability for anybody they allow invest them. I'm not saying these things should not be participated in, but you need to participate in them when you have plenty of other money and you can say, if I lose all of that, I can still sleep well because it will not impact my future. If that's where you are, God bless you. But that's not where the average 401k participant is. That's why this is a major problem that is still yet to be resolved. But the approvals look like they are coming down the stream. You need to be very careful about how you do this. Liquidity drives markets, and where there is no liquidity, when it comes time to sell, the person who needs to sell gets bushwhacked. You're going to get your knees knocked out from underneath you, and you'll find yourself on the ground. The same thing had happened to Jerry Tsai in the 70s. It's the same thing that happened with investors in real estate mortgages in the 08 and 09 crash. When the time comes to need the money and there are no buyers for your asset, you are the one who gets hurt. Liquidity makes a difference. And for 401k plans specifically, in your portfolio specifically, the stock market, the US stock market, has more liquidity other than the treasury market than any other thing that you can invest in the entire world. We're the biggest market for stocks. We're the biggest market for government bonds. We have the most liquidity. We have the strongest legal system that is enforceable anywhere in the world when it comes to investors. And it's always a buyer beware. Pay attention. Don't do anything stupid. Know what you're buying. Be sure you have liquidity adequate to be able to get you out when a day comes for you to redeem the assets, to pay whatever objective you had for that particular asset or block of money. If you enjoy listening to this, subscribe to our podcast stream. We've got more issues coming up. Have a great day.